It's when you are selling investment property and buying investment property, and when you follow certain guidelines and timeframes, you'll be in a position to absolutely defer all capital gains tax. And that's significant because there's federal tax, there's state tax, there's depreciation, recapture, and there's Medicare tax. And when you look at California as an example, because we're in California, every single sale on investment property, for the most part, you're going to lose 30 to 40% of your gain in taxes.
Welcome back to another podcast with the Cornerstone Realtor team. I'm Jamil, and this is James Callejas. Sorry. So welcome to our podcast, James. James, you're with IPX 1031 Exchange, and tell us a little bit about yourself and your company.
Sure. In 1998, I had somebody who was working at the current firm say, "What are you doing right now for a job?" I said, "Nothing that I'm particularly fond of. Why don't you come in for a meeting?" I met with the manager of the firm at the time, and they asked me what a 1031 exchange was, and I said I have no idea, and they hired me on the spot. That was in July 27 years ago, and I've helped over 58,000 investors defer all capital gains tax and build wealth within their real estate portfolio. I take great pride in helping people work the tax code to maximize building wealth within their real estate investment portfolio, and in particular in the state of California, many people do this.
Great. So that's a perfect segue into our first question. And we get questions all the time from our clients, new clients, past clients. Tell me, what is a 1031 exchange and how does it work? How does it benefit the people?
Yeah, it's actually an internal revenue code that's been around for over 100 years. And in the beginning, it was just primarily used for farmers selling farms and unloading farms and buying different farms. And in doing so, they'd be in a position to defer all capital gains tax. But the reality is, I like to keep this code very simple. It's when you are selling investment property and buying investment property, and when you follow certain guidelines and timeframes, you'll be in a position to absolutely defer all capital gains tax. And that's significant because there's federal tax, there's state tax, there's depreciation, recapture, and there's Medicare tax. And when you look at California as an example, because we're in California, every single sale on investment property, for the most part, you're going to lose 30 to 40% of your gain in taxes.
Okay, so let me be an advocate. Why would I want to defer the taxes when I might just end up paying them anyway?
You know, there's a motto in 1031 land, that's buy till you die. Because in real estate, a true benefit is to continuously sell investment properties when they've outlived their purpose, for whatever the reason may be, to go into superior investment property and eventually continuously owning more and more investment properties, different product types, different asset classes. But the true benefit, in my opinion, for the investor is to estate plan for their heirs to the throne, so that you'll preserve all the equity, get better returns on the dollars, and then when you pass away, the basis will be stepped up. So for example, if I bought it for $100,000 and today it's worth $1 million and I sell, that's $900,000 that I have to realize. And in California, I'm going to lose $300,000 plus. But if I were to pass away, the 100 goes up to current value $1 million. My heirs inherit the asset, and at that point, they could sell it and not realize any taxes. So, you know, it's not kicking the can down the road. It's maybe never paying capital gains tax.
So maybe let's change it to buy till you die, but defer till you die too.
Right?
Just keep deferring it.
Swap till you drop, buy till you die.
So I like
however
that.
you want to call it. There's so many different ways to approach this.
Yeah.
Now, sometimes there's reasons to cash out, but for the most part, the true investor is continuously looking to buy superior investment property and estate plan their assets for their heirs.
So this is an IRS code, so this goes across all the states, is that correct?
Yeah, it's a federal code that's been used by every state. California is the most popular because we usually have the highest appreciation and we definitely have the highest taxes.
Got it. Good. That's good information. So what does a like kind really mean in a 1031 exchange? Can I swap a house for a commercial property?
Yeah, I think that's a great question, Jamil, because most people think that they're stuck in a box when it comes to a 1031 exchange. I had a condo rental, I'm selling it, I want to do an exchange, now I got to buy a condo rental, or maybe residential property. But the true fact is, you ask 3 questions, and if you can ring true on all 3 of those questions, it qualifies as like-kind property.
All right.
Is it real property? Is it in the United States? And is it used for a business or investment purpose? And if you could say yes to all 3, it works as like-kind property. As an example, I could sell farmland and I could go buy an office building. Both real property, both used for an investment purpose. So when you can answer these questions, and obviously be in the United States, if you can answer these questions as true, it qualifies. So it can go from residential to commercial, commercial to residential. Many different things qualify as like-kind property. I think the best thing to do, Jamil, is when you're kind of confused on something like this, either email, call, or text me, and I'll let you know if it does or it doesn't qualify, because sometimes it can get a little bit tricky. But for the most part, real property, investment property in the United States, it works.
Now, does a business in a building qualify? So if you buy the business in the building.
The building portion, the real property portion qualifies. The business portion does not. So in many transactions, for example, if you were to sell a Subway franchise and you own the building portion would qualify, but the actual business portion would not. Similar to a gas station. When you sell a gas station, the real property qualifies, but the equipment, like the pumps or like the mini mart business that they have there, doesn't qualify. So unfortunately, you can't take advantage of the business portion, but the real property does qualify.
A lot of people, that's great, thank you so much. A lot of people ask about, can they exchange their 1031, do a 1031 on their primary residence?
So there are three pieces of real property that do not qualify for a 1031 exchange. The primary residence, the second home, and flippers. When we look at a primary residence, sometimes it's mixed use, meaning it's a duplex, right? You live in one unit, you rent the other unit out. Or on your own house, you have an in-law or an ADU. It's mixed use. That portion qualifies for a 1031 exchange. And sometimes you run a business out of your home. That percentage that you claim on your taxes qualifies for a 1031 exchange, or you rent out rooms. You get the idea. If there's a portion of the property that's used for a business or investment purpose, that portion qualifies for the 1031 exchange, but the primary does not. Now, in California, we have massive appreciation, and the Internal Revenue Code, Section 121, allows you to protect 250 to 500 of your gain. If you're married, 500. If you're single, 250 on the primary residence, as long as you lived in it 2 out of the last 5 years. A great strategy that people use is they move out of the property, they rent it for 1 to 2 years, then they sell the asset, they still collect the 250, 500, and they 1031 exchange everything else. So the primary residence does not qualify for a 1031 exchange. A mixed-use primary residence, we could take advantage of both section codes. And a converted primary to investment property, you could also take advantage of both section codes. It's a great question, Jamil, that many people out here take advantage
But
of.
only if you lived in that mixed use, or if you lived in part of it, you could use it for both. Is that what you're saying?
That's right. So if it was if it's a duplex, you live in one unit, you rent the other one out, the rental unit qualifies for the 1031.
So you could do half.
You could do, if it's a half. Sometimes the duplexes are different values, but yes. Or even a triplex or whatever. If you live in a portion of the property.
So let's say I have a duplex and I sell for $1 million and I bought it for 500 just for easy math, and I can take 250 out cash, right? And I could take the other 250 and invest it. Do I have to buy for $500,000 or do I have to buy for $1 million?
So in a 1031 exchange, you need to buy of equal or greater value, not reinvesting just the gains, not reinvesting just the equity. So in an example like this, bought it for 500, sold it for $1 million, it's a duplex, it's 50-50. 500 is allocated towards the investment portion, 500 is allocated towards the primary. The gains, 500. If you're single, 250 will protect the primary portion, but the investment portion, you need to buy something of 500 or greater to pay no taxes.
So it's the same. It's still 50% of it, right? Okay.
Yes.
All right. So that's easy math. Okay. So can I take my single family residence house, leave it for a year or two, and then exchange it, so I don't pay taxes? I made $1 million, or so I don't want to pay any tax. When I buy another primary, can I do that?
When the gain is over the 250, 500, many people move out, rent it, then sell it. If they've lived in it 2 out of the last 5 years, they'll still get the exclusion money, and they 1031 exchange the rest. So let's say
So you could do both.
You could do both.
That's great.
If you convert it.
If you convert it.
But the way it would work is you'd have to buy another piece of investment property. So if I bought a property in Dublin for $200,000 and I sell it for 1.5, and I had moved out and rented it, but I had lived there for 20 years prior to that,
right,
I could protect still the $500,000 as a married person, but then I would have to exchange the other $1 million into something else.
So let's do the math. 200, you got 500, that's 700,000. Let's say you sold for 1.5. So you got 800,000 you have to buy with, right?
$1 million. So you would be able to keep the 500,000 as a married person.
So that's 2 plus 5, that's 7.
So no, but we would look at the sales price,
Right.
1.5. We'll take out the 500,000 for the exclusion money. You have to exchange $1 million.
So you have to buy another property with the remaining funds at $1 million, and there's no taxes.
In a 1031 exchange, another investment property, you'd not pay any taxes.
That's only if you converted it to an investment after a year or more. Is that correct?
So it's a gray area. So it's truly up to your tax advisor to determine how long you rent it before selling it. You don't want to rent it longer than 3 years because then you've no longer lived in it 2 out of the last 5.
Right.
But talk to your tax advisor whether you should rent it to 1 or 2 years before selling the asset.
Now, that's only, I can't do that if I have lived there and it's my primary. I cannot take the 500 and then do an exchange.
No.
That you have to move out
And rent.
and rent it.
Yeah.
Now, okay. Now let's talk about this 500,000. Okay. When the market's hot here, we get over 500,000 sometimes on the offer price, on the list price. So when is that changing? We hear this $1 million number coming as far as the capital gains.
I don't think it's ever going to change, Jamil. I think that in California, it seems like we're going to lobby for it and it's going to come true. But when you go to the Midwest and we look at numbers like this, it doesn't truly translate. And I think the numbers will outweigh us to. And I think the question is the exclusion amount going to increase for a single person to 500, a married couple to $1 million?
That's the question.
I don't think that that's going to happen just because I think the numbers where that happens far outweigh the numbers where we see it happen.
But the IRS is not keeping up with the times. It feels like they're in it for themselves and they're not in it for the people. And we really need that extra $500,000 because a lot of us have $1 million or more in equity would just save a lot of headache. Don't you agree?
Oh, yeah, but our opinion matters.
No, I know.
It does not matter at all when it comes to the IRS and what they want to do.
But it's outdated.
Agreed. And when we look at the Internal Revenue Code, a lot of it's outdated, but I don't think much of it will change, unfortunately.
All right, let's go into how does this actually work? Who manages the exchange process? So tell me about that. Can I just do it myself?
No, you can't. You can never touch money in a 1031 exchange. So in my opinion, the way it should roll out is as an owner of an investment property, you should have a real estate professional such as yourself, but I think the consultation should come prior to listing the property. I want to determine 2 things. Who is the owner of the property and is it investment property? I want to qualify it. And what I mean by who is the owner, sometimes people say they own the property, but it's in a trust, or they own it with others, or it's in a partnership, or it's in an S Corp, a C Corp, or some other entity. I want to make sure the taxpayer that's selling is going to do the exchange. First, we determine that. Then the property is listed for sale. Eventually, you accept an offer. At that point, you would open up escrow. I should be the next call. James, we're in contract. What do we do next? I am known as a qualified intermediary. I am absolutely necessary for anybody looking to do a 1031 exchange because we are known as qualified intermediary, accommodator, exchange company. All means the same thing. It's synonymous. But we come into the mix, create legal documents that allow us to assign into the rights of the contract, create a 1031 exchange account so that the seller does not touch money. And at the close of escrow, the proceeds will go into that 1031 exchange account. Can't touch the money. You touch the money, it's taxable.
So you can't touch any of your money, or can you use what you, let's say you bought a property for 500,000 and you put 200 down and now some years later you want to sell it for $1 million. Can I get my down payment back?
If in a 1031 exchange, the original down payment question comes up all the time. Can I take that money out? Why would that be taxable if I take that money out? Here's the reality on something. If you bought it originally for 200 and maybe you put all cash down to buy the property, now it's worth $1 million and you want that money back. The IRS looks at it. If you take that money is being taken out from the gain portion first, not the original down payment. I would recommend that you refinance that money out probably 6 months or longer prior to listing the property for sale. Because if you take it at the close, it's going to look taxable, unfortunately.
It's called a boot, right?
It would be called and considered boot. So you'd want to avoid doing that. All proceeds go into the 1031 exchange account, reinvested into the next property or properties that you're going to buy.
So basically, you cannot touch a dollar if you don't want to pay tax on your investment property, but you can refinance, get a line of credit, take the money out prior to doing the sale, and then wait 6 months and then do the exchange. So contact a professional like me, a real estate broker first, before you start thinking about it so we can plan. Also, James, what about title information? Like LLCs and changing it from, a name to an LLC or a trust. What does that have to do here?
Again, it's so important, Jamil, that we have these conversations before the property is listed, and I will ask the specific questions.
Got it.
Because ownership, in terms of the taxpayer, needs to remain consistent. And people own the properties and hold title in many different fashions, in many different names. So I want to make sure everything is set up for success in a 1031 exchange. 1031 exchange happens very quickly and is all about planning. And if you do it right, you're going to be a very happy investor.
All right, so tell me about the timeline, because everyone doesn't really understand the timeline. Let me re-say that. People don't understand the timeline. So can you explain what's the timeline?
Again, conversation prior to list property for sale, accept offer, open up escrow, contact the qualified intermediary to set up the 1031 exchange account, which must be done prior to the close of escrow. Once escrow closes, proceeds go into the 1031 exchange account, and then the clock starts ticking. You have 45 calendar days. That means every single day counts to identify in writing the exact property, address, or addresses of what you're going to buy. From day 45, you have an additional 135 days to close on what was identified. So everything has to be done in 6 months, but the first 45 days are critical, because if you can't identify what you're going to buy within that 45-day window, the exchange fails. So know your clock, know what you're going to do, have a plan A, a plan B, a plan C, and execute it as quickly as possible.
James, a lot of times as a real estate professional, what I do is I build in a couple extensions within my contract, either buying or selling. Because if I delay escrow closing, that delays the clock. Because if my client hasn't found anything, that is legal, correct?
I think
as long as I delay.
It's a great idea. Maybe you have a 30-day escrow with options to extend if needed. Or maybe you got into contract on the replacement property contingent upon the sale. There's many different ways, many different things that Jamil could do to strategize to perhaps give you more time so that you can secure the replacement property within the strict timeframes.
It's really important to have the timeframes down, because you could be in a bind. And I know other people that were not my clients at the time that had to buy something just to save the taxes. And I think that's important, is to plan this out. This is not something you can do overnight. Plan it out and find the professionals to help you. We always have a saying, let the baker bake the bread. And that's what we're doing here with having James on the show. Okay, got the timeline. Now, how long do I have to close on the property? You said 45 days. Well, we can't
45 days to identify. Total 180 to close. It's concurrent, so it's 45 and 135. Typically, we don't need that long to close on an asset unless it's new construction being built, would have to be completed within the 180-day time frame. Or there's perhaps, and I don't recommend this, litigation or short sale properties on what you're buying. Commercial assets usually have a longer due diligence period. They're going to probably use more than that 30 to 45 days unless you get started early. So that's just the maximum time frame that we have in order to complete a 1031 exchange. But again, the critical time frame, 45 days, make sure it closes within that 180-day time frame.
Got it. Now, what are some pro tips here that you can give me because you probably do exchanges all day long and every day. So what are the pro tips?
Well, to me, as an investor, find out what you don't like about a property before you sell the property. Maybe you don't like being a landlord. Maybe you would like better cash flow. Maybe you don't like the politics of the current state you're in. Maybe it's a tenant-friendly state. Maybe you want to eventually buy a dream home or a primary residence. You need to determine before listing the property for sale what you're looking for, and then strategize. Have a plan A, have a plan B, have a plan C so that you can execute it quickly. I think quite often people just want to unload the asset without a true plan in play. If you have the plan in play, the percentages for success are extremely high. When you plan once the property's in contract, then the percentages of success get lower. So planning in advance the exit strategy. That's the most important thing of a 1031 exchange. What am I going to buy and why? Because that'll determine your path.
All right, last question. Can I take an investment that I purchased and exchanged so many times, and now I've got, $5 million in equity or $2 million in equity, and then I go buy a single family that I want to live in a year, buy it as an investment property, deferred all the taxes, and now live in it, call it my primary. Can I do that?
Yeah, many clientele of ours will sell an investment property and then buy the dream home or buy the vacation home. What's important is that it qualifies for a 1031 exchange. So initially it has to be treated as investment property. That can happen one of two ways: full-time rental or short-term rental. If you're going to do short-term rental, the requirements are as follows: rent it out a minimum of 14 days per year and do not use it for personal use more than 14 days per year. And I would recommend, if you're going to take that route, do that for 2 years prior to conversion.
So then you just convert it to your primary. You've got all this equity that you built in through your investments, and you're done.
You're done.
James, thank you so much for coming on the show. And if you have any questions, reach out to me. I can get you in touch with James, and we'll get you started on your next 1031 exchange. Have a great day.
Thank you.
Thanks.